quarter, markets have been driven by central bank movements, or lack thereof, and this could continue well into 2025. Locally, the RBA is worried about inflation risk and appears to be firm in their view that interest rates need to remain higher for longer. On the other hand, the Fed and European Central Bank share concerns about a slowing economy and have shifted their focus to stimulating economic growth. Japan is moving in a different direction, and that is up, and unexpectedly, China announced substantial monetary stimulus measures to boost growth and stimulate domestic demand. Policy divergence is evident as each geography battles their own unique issues. Nonetheless, what these economies do share is their common goal to navigate a soft landing, and we believe for the most part they will. The other factors adding to uncertainty is the upcoming US presidential election. While the winner will be difficult to predict, what is certain is that the results will have implications for markets globally. Looking back, equity markets had a strong quarter. Surprisingly, China started the last week of September among the worst performing equity markets and rallied to finish the quarter in first place. Gold surpassed $2,600 per ounce, with investors searching for a place to hide from economic uncertainty. And as rates fell globally, long-duration assets such as infrastructure demonstrated strength. REITs are also among the best performing equity sectors both locally and globally. Looking ahead, we are optimistic for investors and believe opportunities exist into the next cycle. Investing can be risky business. Investors must navigate more risks than central bankers and approach assets selectively. We think a good place to start for those looking for more defensive opportunities, or simply a place to hide from uncertainty, is to focus on gold. With many of the world's developed economies struggling, gold has shone. We expect the price of gold to remain supported at current levels, with the potential of climbing new heights. What's more, gold miners are still undervalued relative to the price of gold, and we think with their strong positive cash flows, they could outperform the yellow metal into the back end of 2024. More recently, emerging markets appear less correlated to US growth concerns and instead are linked to commodity prices and country-specific drivers. We believe this relative strength could continue. Both emerging market equities and bonds offer greater risk premia, and their fundamentals are strong relative to their developed market counterparts. We would encourage investors to consider emerging markets in portfolios, although it is important to be selective. Now let's turn to Australian equities. With such strong migration numbers and a lack of new housing, we expect house prices and rents to continue to put upward pressure on inflation. Though the Australian equity market appears to be comfortable with the RBA's risk focus, and it continues to feature the world's most expensive banks. Markets are pricing in RBA cuts to start by Feb 2025. Our view remains that this is unlikely and we won't see a cut until well into 2025. We would also encourage investors to be mindful of inherent concentration risks that exist within the Australian equities market. Lastly, small companies present a compelling opportunity. Historically, they have offered more upside when central bankers pivot from raising rates to cutting rates, which is what we are seeing. But again, it is important to be selective. Want more? You can read our latest viewpoint, Risky Business, at vaneck.com.au.